So fine. So we are recording now. So hopefully the people who have missed or can't make it today, we can share sometime the information with them.
Yeah, brilliant. That's great. I think the microphone's dropped out, but I'll introduce myself while I'm here. It's nice to be with you all again. First time in a couple of months, but my name's Grant. I work for Harvey Bowes, who are a specialist finance brokers based in South Wales, of all places. But we deal with people from all over the UK and into other countries as well. So we can actually currently call ourselves an international company, which is quite good. We deal specifically with mortgages and short-term finance for property investors. Everyone in the company is an investor to some degree as well. So we understand the pitfalls and also the successes that come with investing in property and the journey that everyone goes on an individual basis. So that's great. Thanks ever so much, Sumit. Hopefully you can all see my screen now. Is that showing up okay?
Yes, it's all great.
Perfect. I made this mistake of doing it the other night and things did not go to plan the way I expected. So I'm pleased this is the first time, first effort, works first time. So yeah, it's lovely to be with you all again tonight. The last time I was here was back in August, so it's been quite some time. But it's nice to share with you a couple of things that we've tried to do to make fairly relevant to this evening. I know that Sumit's got an amazing meeting lined up for you all. So the couple of things that I wanted to share, hopefully will tie in with that a little bit more. There's one or two new things that have come about in the last 24 hours that I would like to briefly share with you as well. But just a couple of things about us as a company, a bit about some of the ways that you can finance your deals if you're looking to add value, and then a couple of tips on limited company buy-to-lets as well at the very end. So it kind of makes sense, first of all, to share with you a little bit about ourselves. So who are Harvey Bowes? Well, essentially, as we mentioned earlier on, we do have clients throughout the whole of the UK and abroad, but our main thing is that we are property investors ourselves. All of the finance that we deal with is by investors for investors. And we do pride ourselves on the fact that, you know, we understand property investors, we understand the successes and pitfalls that come along with that. And it's a really nice way of being able to share our passion, but also get involved in the passion of other people as well. We specialise in HMO properties, multi-unit blocks, developments, bridging and buy-to-lets. And more recently, we've also started offering services for second charge mortgages and secured home loans as well. One of the major things about Harvey Bowes is that we've been established since 2006. Now, that may not necessarily jump out at you as being a particularly impressive milestone, but coming out of the back of what's been a very difficult year, we've been in situations like this before. The company actually started up pre-credit crunch and was one of the main brokers in the UK that was able to continue through that period and come out the other side. Apparently at the time in 2006, there were 33,000 mortgage brokers throughout the UK. After 2008, there was around 10,000. So numbers dwindled significantly, which did mean that the majority of the brokers that were really worth their salt were able to get through it. And, you know, we really pride ourselves on the fact that we've been there through tough times before. We're going to make it through this one as well. So one thing that I wanted to share with you, and it is a little bit about mindset. You've got to think about your broker as a creative agency. Now, I've always said this at Harvey Bowes, a little bit tongue in cheek, but I do truly believe that you don't go to a mortgage broker just because they offer mortgages. You go there because of the way they can arrange these, their why, as it were. And I think it's probably one of the most incredible and simple lines I've ever read in a book. People don't buy what you do, they buy why you do it, by Simon Sinek in the book Start With Why. And I think this really backs up the fact that your mortgage broker should act as a creative agency for you. So what I really mean by that, if you think about the mindset of why you would use it. So your mortgage broker should think outside the box and be creative problem solvers. So if you go to a standard high street bank, they will look at things from the perspective of a high street bank. When you go to a mortgage broker like ourselves that are whole of market, they have to understand the whys and the wherefores of every bank that's available to them on their network, which means they really have to think about criteria at every step of the way. Now, generally speaking, I would be very surprised if the majority of our work that we do at Harvey Bowes is bog standard, basic buy-to-lets. And I don't want to belittle those because they're an amazing way of diversifying your portfolio. But generally speaking, especially now, people have got situations that they've come up against or they're currently coping with. Not every case that we see is a straightforward case. There's always something that makes it a bit more specialist. And I think this is really where a good broker comes into their own, because they can look at things from lots of different points of view to try and come up with something that's going to be really, I know it's a bit of a cheesy word, but very bespoke to you as an individual. And there's no template matching either. Now, I have to explain why this is important. When it comes to a one size fits all, now I used to work at Apple for many years. And one of the things they taught us was that there's no such thing as template matching. Just because you've seen an issue once, it doesn't mean that it's exactly the same issue time and time again. Template matching is the idea that everything will always be the same based around one perspective. And when you're looking at the mindset of how your broker deals with your inquiry, everything is individual and bespoke. You know, we've done a lot of work with Martin and Sophia over the years, and it's nice that they can see that firsthand as well. But really understanding the clients and what they need and how we can get things to move forward. And ultimately, probably one of the most powerful things that you can think of, seeing past roadblocks. I always used to suffer with creative block when I was back in my design years in my early career. And creative block is one of the most frustrating things that you can come up against because it really does stop you in your tracks. But sometimes the best way of seeing past these roadblocks is by being able to, as a team, all mull in together and try and work out a solution. And that's one of the most powerful points of using a good broker. They've got a team that acts as one unit. And then perhaps some more of the soft skills. Brokers should be people first, have open communication, and be able to build a lasting relationship with you. You don't want to deal with someone that is never available for you, or is never willing to talk to you or offer you continued advice. You should have a relationship that becomes almost family-like or almost on a strong friendship. And that's absolutely crucial. But also, as we mentioned earlier on, whenever you use your broker, whether that's us at Harvey Bowes or someone else, we know the lenders and your broker will know the lenders, and they will always try and find a way to say yes. It might not be that it comes at the first attempt. It might be that you're having to do things and try and find creative solutions on a couple of occasions. But there is always a way of finding you like a scenario to make things work. I think that's the key takeaway from that. So what about financing when it comes to adding value? So there's a couple of creative strategies I wanted to show you on this. Now, you have to take creative as a way of, again, perspective. It might not be that it's the most outlandish creative thought, but sometimes you have to think outside the box and find ways of doing what you need to do, perhaps in a slightly different way. So the first way that we can finance when adding value is by using a bridging loan, adding our value, then moving on to a term loan. So this is quite a simple process. A lot of people tend to do this. So we've used an example here in our first strategy of Roma Finance. Their rates are from 0.95% a month up to 75% loan to value and 100% of the works that you're looking to do to that project. And you can do this over a 12-month term. Now, this is a really good way of ensuring that you can get the finance you need if the property perhaps isn't in the best state. I think one thing that mortgage companies tend to like to really anchor onto is the fact that the property has to be available to let from the time the mortgage completes. If it's not, that's where a bridging loan comes in. So you can finance that purchase, put the works in to make sure that that property is completely livable. And then after you've added that value, you can move on to your term loan. Now, the beauty of this is that assuming you've done these works, you've added that value, you can then look for your term loan at the uplifted property value. Okay, so let's just hypothetically say that your purchase is for 100,000. You want to add £25,000 worth of works, and you're hoping that the property is going to be worth 150,000 by the end of it. I know they're very hypothetical numbers, but let's look at that from the best case scenario. Well, when you exit your bridge to your term lender, we've got an example here of Foundation Home Loans. They offer a specific bridge to let product. Now, this means that they're only keeping this available for people that are trying to exit from a bridge. So they've got the expertise to make that happen and to make it happen on time as well. This time you can look at up to 75% loan to value at rates from 3.19. And this is also perfect for first time landlords. Now, this means that you're going to look at that 75% loan to value from your uplifted price. So from 150,000. And this is a great way of being able to take money out, clear your bridging loan, and then start to look at where you can build momentum with your portfolio and add that money that's been taken out into your next purchase. Now, if you want to go through any of these in a bit more detail, you're more than welcome. Drop me an email or give us a call from the number that's on the screen. I have also got a QR code in the center there, so you can connect with me on LinkedIn to learn a little bit more about this in some more detail. Our second strategy, using a lender that has the ability to offer a further advance. Now, this perhaps is a bit more straightforward, and this is a great way of being able to buy somewhere, add the value, but then still take that money out at the end. Now, there is two caveats to this that I do believe we should mention first. A major technicality: the lender will require all works to be completed within 28 days of the mortgage completion. So if you're looking to turn a 3-bed property into a 6-bed HMO, you're probably not going to do that in 28 days. So it's not really suitable for everything in that respect. But for everything else, this can work really nicely. So our second strategy is to go with someone like Kent Reliance, who have got their rates from about 3.04%, very much on the market leading side, certainly for limited companies. 75% loan to value, again, perfect for new landlords. I believe with Kent Reliance, their only real caveat is that you own a property in the background. So if you've got a residential home and you're looking to buy your very first buy-to-let property, absolutely fine with Kent Reliance. You can then add value with your own funds, or if you've got a few things you want to do to it, perhaps a bit of a decorating job, some kitchen refits or anything like that. After you've done all of these works, you can then do what's known as a further advance. Now, when I say on screen, it's up to 75% loan to value. The good thing about Kent Reliance is that in the past, they've gone up to 85% loan to value. So imagine you've done a purchase for 100,000, for example, you've put your own money into it, and then you want to do a further advance at your uplifted value. Well, you can do that. It's actually a little bit simpler, because a further advance is essentially you taking out another loan against that property with the same lender. So Kent Reliance will go, right, well, you bought the property for 100,000, it's now worth 150. So you've got around 50, 60,000 of equity in the property. So you can borrow up to 75% or up to 85 if they go back to that, of that uplifted value. Now, the beauty of this is that the minimum loan size is £15,000. So that means even if you've only added a little bit of value, you can still take that lump sum out, put it towards further investment, and continue your property journey. So it's really useful, and it's a very popular way of being able to strategically make things work with your investments. And now this third one. So this is a brand new product, and we were only introduced to this yesterday afternoon, so it's worth exploring this in a bit more detail. But Redwood Bank actually have a bridge to let product. Now, they're not a short-term lender, but they offer this as a specific package. So with Redwood, you can do up to 65% of your purchase and 70% of your works, up to a 12-month term at 8% per annum. Now, 8% might seem like quite a lot, but if you compare that with a lot of the other bridging lenders that might be lending money out at about 1%, it's quite a big difference. It's about 4% difference over the course of a 12-month period. Now, this is all done in phases. So essentially what you would do with Redwood is take out this short-term loan, you would then add your value, and then they would put you on a term loan, which is the let part of the product, which is on their phase 2 residential. So this means you can borrow up to 70% loan to value of the property, up to a 10-year term for this, and your rates are from 3.99% plus the Bank of England interest rate. So it's actually quite a viable and very cost-effective way of going from a bridging loan to a term loan with very little in the way of additional costs in the middle, because that can be the biggest difference sometimes. If you're looking to go from a bridge generally to a mortgage lender, you've got lots of sets of legals, lots of sets of valuations, etc. This is much more streamlined and a lot cheaper. So again, if you need any additional information about this, then by all means get in touch. But perfect for people that are looking to do semi-commercial buildings. You know, if you've got a pub with flats upstairs, if you want to just keep things simple by going straight from your short term to your term loan, but also they take into account specialist tenant circumstances. So if you've got asylum seekers, if you've got people that are in a sort of slightly fragile state, or in trying to think what the word is, they're in a transitional state, or if you've got perhaps sort of bad tenants, you know, they actually look at things from a broader perspective. And the loans start from a minimum property value of 125,000 as well. So particularly good in different parts of London, where I'm pretty sure that your minimum property value is going to be significantly higher than 125,000, but that's premium for Wales. So finally, I just wanted to share my thoughts on financing through a limited company. Now, this is more our thoughts based on what we've seen in the office, some of the things that come up that we need to consider. So my 3 tips are, first of all, your limited company should be an SPV, or a special purpose vehicle. A lot of mortgage companies don't like lending to trading companies just because of the assets and the liabilities that come across with that. A special purpose vehicle is specifically a setup that says I'm only going to be acquiring property and letting it out. There's going to be no trading element of it at all. So this is a really, really good tip if you are looking to set up a new limited company in particular. Second tip is to ensure the correct SIC code is assigned on company's house. Now, if you're fairly new to the idea of SIC codes and limited company buy-to-lets, the SIC code is the, generally speaking, 68100 style number that you'll see on company's house. There's 4 or 5 that the lenders are happy to lend to, but it's worth bearing in mind, probably the most popular one is 68100, which is a company that's been set up specifically for rental properties. The only reason we say that is because what you'll find is that a lot of lenders are very specific about what they feel comfortable lending to. Their risk profile changes across the board. So you want to make sure that you're as broadly acceptable as possible. And now tip number 3, amount of directors and shareholders can have an effect on your lender choice. Just to put this in a bit of a broader scope, this basically means that if you've got an odd number of directors and shareholders, some mortgage lenders will find this as high risk. So it might be that it limits the amount of lending options that you've got. Where a lot of people feel fairly happy. So for example, we mentioned Kent Reliance, we mentioned Foundation Home Loans above. They allow up to 4 directors and up to 4 shareholders as part of a limited company. We had one recently where there was 2 directors and 3 shareholders, and it did actually mean that the products that the customer wanted, they weren't able to have because the lender wasn't happy with that structure. Now, that might seem a little bit ridiculous, but sometimes you've got to play the game to make it work. So just have these 3 things into consideration when you are looking to do a little bit more with limited companies.